US producer price inflation data was hotter than expected. US bond yields are up, as is the US dollar. US stocks, they're down. House prices in New Zealand are flat, although net migration set new record highs. And iron ore could fall under $100 a tonne. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ Chief Economist for Greater China Raymond Yeung wraps up his analysis of China's National People's Congress. He says the focus is coming off the annual growth target and on to structural reform as China pushes to be a middle-income economy.
We really have to have this understanding of why the government seems to be downplaying the growth target, because now the focus is more long-term rather than a short-term economic performance just for 2024.
But first, in 5 and 5 with ANZ, US producer price inflation data was hotter than expected overnight. So US bond yields have spiked as much as 10 basis points. That drove down US stocks by 0.5% and lifted the US dollar against other currencies, including the Aussie and Kiwi dollars. The Aussie was down 0.5% at 65.82 US cents at 5 a.m. Sydney-Melbourne time, while the Kiwi was down 0.4% at 61.31. US producer price inflation was 0.6% in February. That was double the market consensus for about 0.3%. ANZ economist Bunzi Madhavani says the data led to markets reducing the expected chances of a Fed rate cut in June to around 65% from 80% earlier.
Even the core number was slightly higher than expected. I think what it suggests is that there is a pickup in cost pressure at wholesale level, and that just complicates the inflation challenge for the FOMC. What's important to note is also that there are indicators from the PPI that feed through the PCE number as well, which is the Fed's preferred mode of gauging inflation. So if you see a stall in progress there on disinflation, that seems to be the concern that spooked the market as well today.
Number 2, US retail sales data for February came out overnight and was sluggish, with the control group measure, which strips out volatile fuel, food services and building materials prices, actually flat in February. Here's Bunzi.
What we noticed is that discretionary demand-related sales were largely down. So furniture and furnishing sales were down 1.1%, clothing and accessories was down 0.5%, health and personal care spending was also down 0.3%. To us, it suggested that, consumer is largely getting cautious around spending.
Number 3, New Zealand's housing market went sideways in February, with prices up 0.2% in seasonally adjusted terms. However, sales bounced 6.9% from a record low in January. ANZ senior economist Miles Workman says the 2024 outlook is mixed, with government policy, mortgage rate declines, labour market loosening, and macro-prudential changes all pushing and pulling in different directions.
As far as the Reserve Bank is concerned, they will care insofar as it starts to affect household spending behaviour and therefore CPI inflation pressures. And at the current juncture, at least up until February this year, we can say that there isn't a huge risk stemming from the housing sector to the household sector, and therefore not a huge risk for CPI inflation at this stage.
Number 4, New Zealand recorded record inflows and outflows of migrants in the year to January. But the recent record upswing in net migration looks to have turned. Miles says monthly net inflows have been getting smaller, but there was also a surprise in yesterday's data.
The quirky thing with this data was that we actually saw also some historical revisions to prior months. And what that did is increase the annual sum of migrants by about 5,000 people versus our prior understanding. So the upshot is we had a weak month, but the revisions basically mean that the annual run rate for migration is stronger than we previously thought.
Number 5. There are warnings that the iron ore price could slump to $100 a tonne. It was $140 in January. The Australian Treasury yesterday indicated the price drop for Australia's biggest export will affect government revenues as he looks to deliver a budget surplus in May. ANZ commodity strategist Sunny Kamari says iron ore is dropping on investor disappointment after China's National People's Congress.
The recent decline in iron ore prices is linked to, the lingering concern around this property sector. And the investors were expecting some details around supporting measures to revive the property sector, which they did not get. And that has triggered this strong decline.
Sunny Kamari there. Now, in today's bonus deep dive interview, ANZ Chief Economist for Greater China Raymond Yeung wraps up his analysis of China's National People's Congress and tells us why there is less fanfare around the annual growth target this year and a greater focus on new productive forces.
Well, before the NPC, I think the market has been, as always, focused on the growth target announced by China, as well as other economic target or forecast by the State Council. We all know that they stick to the same, 5% target, and also with a rather unrealistic target for CPI or inflation at 3%. And it doesn't seem that they are really paying serious attention to whether China can achieve this inflation target, because we all know that China is faced with the deflation problem. So if you ask me whether China can achieve even 2%, inflation this year is already a very ambitious target. But anyway, you also mentioned about this new production forces, which is the meat, of the NPC, because it tells us that at least the party central, not only the State Council, focused more on structural reform. So if you ask me the overall government work report, structural reform is still the main theme rather than the cyclical economic performance. Even though we do expect that the government will continue to support the economy, to support and hopefully to stabilize the property market by providing more measure, and also trying to support domestic demand and household consumption. But at the same time, technology and innovation remains the main theme, in the whole report. So we have to know that this year is the second last year before the 14th five-year plan, which is next year, 2025, is the final year of this 5 years plan. At the same time, this first 5 years is the first 5-year plan of Xi Jinping overall phase one of a new era. And his vision for the first phase has called for pushing China into a medium income country by 2035. So with this, I believe they are still sticking to this reform mindset and prioritize structural reform over cyclical performance. And we really have to have this understanding of why the government seems to be downplaying the growth target, because now the focus is more long-term rather than a short-term economic performance just for 2024. So with that, then I think more have to focus on what sectors China is supporting and what would be the implication of the industrial transformations, and how the downturn in the property market can be somehow translated into bigger consumption, because now household has got a lot of saving in the deposit as a form of bank's deposit, and how the government will encourage the use of household saving and translate it into domestic consumption will be key to support China's sustainable growth, in the future.
Raymond Yeung there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, March the 15th. Catch you next week, where we'll have policy rate decisions from the FOMC, the Bank of Japan, and the Bank of England. Or as I call it, Central Banker Palooza Week. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.